Welcome back to the Global Goals Studio at this time of the Davos Agenda. And thanks to Goal 17 Partners for hosting this segment on ESG investing. This week, the World Economic Forum announced an initiative that brought together 61 signatories in support of reporting on metrics to disclose their environmental, social, and governance practices. While it's a major step for corporations, the question is, will it have a catalyzing impact on the investment community? To discuss that, we're joined today by Karen Fang, Global Head of Sustainable Finance for Bank of America, Jim Pass, Senior Managing Director of Guggenheim Partners, Megan Starr, Global Head of Impact for the Carlyle Group, and Richard Matheson, Chief Executive of Trucost S&P Global. Welcome to you all. The World Economic Forum met yesterday, and this video jumped out at us, or this piece of a video jumped out at us. Let's listen to it and talk about it on the other side.
As large employers and as employers, we have to take care of our teammates, and we took a teammate-centric, customer-centric view of this, and that was really about protecting them, paying them well, and I think that's how we do it.
First to you, Karen Fang, since it's Bank of America, what market mechanisms are needed to grow sustainable finance at scale?
Absolutely. Thank you so much for having me. And I think to answer your question, we have to first draw the distinction between ESG investing with sustainable investing. I think that those two tend to be confused with each other. And if you look at ESG investing, you will feel pretty good about yourselves, because in the US, we have $51 trillion of assets under management that is professionally managed. But the data shows that $17 trillion have some kind of ESG filter, negative screening, positive screening, shareholder activism, et cetera, et cetera. So that data would tell you that almost 1/3 of the professionally managed US assets is actually ESG investing. Well, that may sound great when you think about UN Sustainable Development Goals, and you talked about sustainable finance. In our mind, is actually a subset of that. So that is the conscious investing and financing of environmentally decarbonizing activities, as well as socially inclusive activities. And that probably is not $17 trillion today, because that would make our work, to advance against the 2030 agenda all of a sudden a lot easier if there's truly $17 trillion deployed. So the point I want to make is that, first of all, that distinction is very important.
Yep.
And when you think about the sustainable finance, I think it's divided into this environmental pillar and the social pillar. And the intersection of that is also very, very important, as I think evidenced by the Biden administration's new agenda via executive order to establish a environmental justice department. So I think that's where sort of you start seeing this intersection, and that's going to become very, very important. When I think about sustainable finance, what market mechanism, your question is a great one. I think the ESG capital markets exploded. I don't have to give you all the data to show you that ESG bonds, between green and social and sustainability bonds, those are great inventions, by the way. And there's a lot of innovation on KPI linked. But basically, in the interest of time, that market exploded. $1.2 trillion have been issued so far, but almost half of that was done in 2020. And in addition to green bonds, which also grew, social bonds basically grew almost 10 times, and sustainability bonds grew almost 3 times. So we saw over $500 billion issued in 1 year by governments and agencies and corporates. Those are very, very important mechanisms for the public market. We see more wind and solar and EV securitization. That's also a very welcome market mechanism. But I do think we need to have more private market instruments. That's whether blended finance between the public and private sector, to help these more private equity, more venture capital, more infrastructure and green project finance to be done, not just for wind and solar and EV, which actually has made a lot of progress, but also new innovative areas like clean hydrogen and fuel cell and battery storage, EV charging station. So in the interest of time, I'll hand over back to you, but I think there's a lot of work to be done for the private markets.
Well, we're talking about big numbers and it's a big subject. Jim Pass is a good point to bring you in. Institutional investors certainly have shown they've got this willingness and risk tolerance and the capital, as we've heard, for prudent ESG investing. Where are you seeing the greatest interest globally? And has that interest increased in the United States as it has around the world?
Well, thank you, Richard, and thanks to Goal 17 for hosting this important discussion. I think to answer your question is yes, there's greater interest globally, definitely in the United States. But I think the one thing that I would comment on Karen's point is that I don't think we have the luxury of separating the E and the S anymore. I think 2020 proved that just with the recent announcement with the Biden administration, what the WEF is doing, I think everything has to be taken into consideration when you're trying to attract institutional money into an infrastructure asset or a portfolio that is marketed or talked about sustainability. So I do think it really boils down to data. And how do you, if you can measure it, financial institutions from the professional institutional asset managers such as Guggenheim, we have the toolbox to manage that risk. And I think it really boils down to how do you analyze, the green or the environmental capital, the social capital, transparent capital, and blend it into a financial analysis. And at Guggenheim, we call those four characteristics really our sustainable quotient. And we've been spending, numerous years and a lot of partners, ranging from the WWF to Stanford to Tufts University and so forth, on how do you create a standard that is going to be accepted by the institutional investor when they want to analyze their investment. Because ultimately, my team and others at Guggenheim will be held accountable if we claim that our portfolio is sustainable and the investment is, but how do they know? How does the client know? And I think really the journey that 2020 proved is, yes, it's very well accepted and it's very important. So the future of ESG investing is strong, but ultimately who's going to be accountable for those standards? And I think that's the challenge, because over the last, 6 months, 18 months, whatever you want to say, it's been focused on the environment, climate to a certain degree. And now with the Biden administration, it's at the forefront again. But I also think we have a new member to the table, and that's social justice. And that, initiative swept the globe in 2020. And so if we would be having this conversation a year ago, I think we all would be focusing on environmental concerns, maybe some social gender issues and inequality and along those lines. But I think now they're both equal. And I think that's going to be a challenge that, we have the resources to meet, but it's going to be something that's going to take some time to really demonstrate that, we can measure it accurately and report it accordingly.
Surely. Well, we're going to take a short break here. Please stay with us. You're watching the Global Goals Studio. We're going to be right back.